Hello. A famous Oscar Wilde line is that a cynic is someone who knows the price of everything but the value of nothing. And he might have added that a cynic would be a pretty rubbish investor as well. In this episode of Outperformance Matters, we're going to banish cynics and explore value in investing and discover that it describes rather more than you might think. I'm Richard Edgar, and this is Outperformance Matters, the podcast from Blue Whale Capital. Well, we're guided, as always, by Stephen Yu, Chief Investment Officer of Blue Whale Capital. Welcome to you, Stephen.
Hello, Richard.
Hello. Now, we're going to get to value investing shortly, but first of all, explain why you think that it's so important.
So I would say value investing is one of the most misunderstood terms in my industry, having done this for 25 years now. And I would also add that every successful investor is a value investor themselves, embracing value investing.
Well, that sounds intriguing. We'll get to that a little bit later on in the podcast. But first of all, we're going to cover current developments in macro and markets. Well, Stephen, the question that's on everybody's lips, it's still on everybody's lips because we have covered this in the past, is whether we're in a bubble, whether markets are in a bubble. And of course, AI is a very large part of that. We've seen the S&P and the NASDAQ in the US. Both of those have come down from the peaks of the end of October. Falls here in the UK as well. Bitcoin has lost almost a quarter of its value over the past month or so. So coming back to AI, and maybe you're getting fed up of questions like this, but is it a bubble?
We would say that we're not yet in a bubbly territory today. After investing into NVIDIA for the last couple of years, I would say that today we are seeing more tangible delivery from AI than any time over the last 2 years or so, when NVIDIA surpassed $1 trillion in market cap in 2023. But of course, at the same time, you need to look into different parts of the market to determine whether it's a bubble or not. And I would say that three parts to the market. The first one is the private market, which will include the valuation of OpenAI or Anthropic and many startup AI companies. They do not have a lot of revenue. They are loss-making, I would say, at the moment. And if you look at the valuation of these companies, you can definitely say that they are in a bubble. Of course, whether they end up being a winner or not, we have to see about that.
And so it's a bubble because this is speculation has driven the price up rather than any evidence of a return on the investment that they're making.
Correct. So there's no much of a revenue. If you look at OpenAI, ChatGPT, they have about 800 million users globally, which is a very good number that they managed to achieve in the last 3 years. But the number of people who are the paying users is only about 5%. And if you look at the valuation of OpenAI on a headline basis, is probably between $500 billion to about $1 trillion with very little revenue to justify that.
But public markets, what's going on there in contrast to private?
So within the public domain, there are two parts to it. One is the big tech companies, the Magnificent Seven, excluding NVIDIA. These companies are the AI spenders. So at the moment, they're burning a lot of cash to invest into AI just to be part of the arms race. We don't know whether their investment is going to be successful yet, just because the return on investment, whether they will get the money worth, we don't know. At the same time, it's also not a guarantee they will come up with the most competitive product. Only because you are investing money doesn't make you a winner. So in terms of valuation for the big tech companies, the AI spenders, we are very cautious just because if you're using free cash flow yield as a valuation metric, is very expensive compared to the history of the big tech companies. But the second part to the public market domain is if you look at NVIDIA valuation today, I mean, we are in the middle of November today. NVIDIA 1 year forward PE ratio is still only trading at around 30 times earnings.
Which sounds a lot.
But to put in context, is similar or in line with Microsoft, Apple, and MasterCard, which they are all trading at 30 times earnings. Of course, if you compare that to the UK stock market, it's a lot lower. It's probably about 15 times earnings. But at the same time, you also need to put in context that NVIDIA is making a 50% free cash flow margin. So within the $200 billion revenue they're going to make this year in 2025, they're going to deliver $100 billion of free cash flow for shareholders. So to us, that is actually a very attractive valuation if you believe the AI journey is going to continue.
So within AI, and this question that isn't going to go away, I've probably got to apologize in advance for, I'm sure I'll ask you this again in future, but within AI, your point is that there are 3 different types of company. They're not all the same, and with a different return on the investments that justify or don't the multiples that you're seeing.
That's a very important point just to illustrate this. Is there's a difference within the AI world between the AI spenders, so including OpenAI, Anthropic, including the big tech company, they are actually investing heavily into AI today. Hence, the valuation is not very attractive. On the other hand of the spectrum is about companies that are on the receiving end of any AI investment. So that would include NVIDIA, Broadcom, Vertiv, or even Hynix, which is a memory storage company. And so if you're on the receiving end of any spending, you are actually making more money today than any time in the history of those firms.
How do you answer the skeptics who say that AI is, just another fad like blockchain? We all got excited about blockchain. I talked at the beginning about how the price of Bitcoin, as one expression of the air going out of that market. Is this not just another fad?
So I would probably use a few different scenarios to outline this based on history. One is if you look at the crypto market, it's been around just close to 20 years. And I think in today's world, despite the fact that Bitcoin has gone up a lot in value in terms of the price per Bitcoin, we don't have many tangible use cases in the real world. So then I think where we got to in the AI world today is, firstly, we are seeing a lot more tangible AI application today than 2 years ago. And I think a lot of them are actually value adding. And at the same time, how AI is going to transform the world is not just between you and I using ChatGPT, which is a smarter version of Wikipedia. It's across many industries. We are talking about personalization in terms of personalized advertisement alongside a personal assistant. It's going to at some point have personalized medicine. It's going to accelerate drug discovery. And of course, then you think about the banks, the different companies that we are using the services for. They would also embrace a bit of AI to increase productivity or to streamline the efficiency. When you put all these 2 things together, there's actually a lot of things going on within AI.
So you are convinced by the future potential of the benefits, the tangible benefits. You've used that word several times, the tangible value that's being added by AI and will be added to the economy by AI. And that justifies the prices that we're seeing for those types of companies. Just to challenge that, there is, though, definitely speculation that is driving share prices higher. There's momentum behind them, which is helping to push them up. Is that a worry for you? A lot of people are talking about this being the wall of worry when you keep staying invested as you see prices go higher, but you're getting worried about when they might topple.
It's definitely a worry just because everything is connected in a way, right? If you have a lot of money being invested into an area, which is AI today, and not every single company would be successful and people would lose money. And of course, it does cause a bit of concern just because this is, I think it's very big. I think it's the biggest thing that we've seen today, just because every companies are able to embrace AI, or every one of us could embrace AI on our own. So I think what you need to do, though, on the back of that is you really need to focus on the fundamentals of the company that you invest into with facts, numbers, and evidence. And then you need to equally avoid companies that might not be able to give you that. But at the same time, of course, you still need to stay very on top of the development. It's not something that you just invest into and then you come back in 5 years' time and you're hoping your company is going to be a winner. I don't think it works in this setting here.
No, you can't just hope for the best. You've mentioned a concern, and I asked about worry. How do you manage, as a fund manager, how do you deal with worry as you see prices as volatile as they can be?
So I've been through, over the last 25 years or so, I've been through different parts of the market in terms of bubble, including the tech bubble, followed by the global financial crisis, and then later on with the pandemic, the digital kind of winners, and then now we have the AI. So I would say that the common theme among them is some of these things can last a lot longer than you can imagine. Like you could be calling it a bubble today, but maybe it would then pop in 5 years' time, or if not 10 years later. So you need to get the timing very, very much intact. But when you go through the journey, I think what is really important if we end up to be in a part of the market that actually the bubble would pop, you need to focus on the fundamentals. So I think as an investor, you need to be very conscious of what you're investing into. So then it's backed by substance.
So you're talking about fundamentals. So you're going back to the numbers. Does that mean that you're parceling any emotions that you have and putting them to one side and just look at the numbers?
Correct.
That's the discipline.
We have talked about this before. For example, if you had invested into NVIDIA when it surpassed $1 trillion back in June 2023, today NVIDIA is more than $4.5 trillion. There's many points within that journey in the last 3 years or so. You could have just called it a day and say, I have made enough money, I've trebled my investment. Why don't I just take the profit and then I can move on to something else? That's one way of doing it. Of course, people are concerned whether that journey would continue. But I would suggest that as a successful investor, you really need to look at the fundamentals of a company. And if you look at the money that NVIDIA ended up making today in terms of that rise versus 2022 or 2023, it has gone up a lot higher than the share price increases. So hence, when you look at the valuation, which I talked about earlier, that NVIDIA is trading at a much lower valuation today versus 2023, because they're now delivering a lot more earnings that are tangible. So hence, if you focus on the fundamentals, the facts, the numbers, then it helps to take away your emotion. So you need to make rational decisions, not based on irrational feelings.
Beginning to remind me of Kipling about keeping your head when everyone around you is losing theirs. I've misquoted it, but I guess that's the point. If you're looking at the numbers then and you're not getting caught up in the emotions of those around you, what are the warning signs, the warning signals that you look for that would make you pause and go, hang on, this now, despite the fundamentals, or maybe it is the fundamentals and the mismatch with the price? What are the things that would make you go, actually, I think now's the time to pause?
So one thing is very important to focus on, apart from whether an investment would actually deliver tangible value, which AI is delivering today, is about the friction. It's about the friction, which means the journey that would take for your investment to realize the return, which could be a month, 2 months, or maybe a couple of years. So within AI, I think there's two things that people can consider as friction. On its own, there's almost no friction. Just because AI is all about readily available data on the internet, that AI algorithm is trying to analyze, trying to make sense of, and come up with use cases. There's no friction in terms of end users adopting AI. I've already mentioned OpenAI just took 3 years to get to 800 million users versus the internet era took 13 years. So there's no friction. But the two friction I think people need to watch for, one is government regulation. I think at some point we're going to see government regulation just because it could become out of control, and then the government want to slow it down just because they don't know how to handle it. And there's many implications for the society on the back of AI as well. The other one is energy, or the sources of the power, which when you are following the big tech company today, they are investing very heavily into nuclear energy. At some point, I do think that we're going to get to a bottleneck, and then that's going to slow down the development, so which might take a bit longer for new product to come out to change the world.
But probably ways around that as well. You might have more efficient systems that don't need as much power, regulation, government stepping in. I can see that happening, but it's become such an international development now that governments would have to act in concert, which seems very unlikely in the current situation, the current geopolitical situation. So perhaps the frictions that aren't there at the moment anyway are a more distant prospect. It's just going to carry on.
Correct. And hence, I think the bubble is not being formed today yet, but in a few years' time, it could be the case.
Of course. Well, let's take that long-term view, which is in fact what we're going to do in the next part of our discussion. So, Stephen, we're now going to do the deep dive, and we touched on this topic at the beginning of the podcast, but it's about value investing. It's a term that might be familiar to listeners, to viewers. We're going to touch on value, growth, and quality, which are ways of describing companies and the way that they are performing. Before we get into it, how did you develop your views about those companies and ways of investing around them?
So that journey started just over 25 years ago. So when I first started my career, I was involved speaking with fund managers, basically running a fund of funds. And I was
a fund of funds, just to explain, is a fund, an investment fund, which itself invests in lots of different funds. So you're sort of choosing the best fund managers that you can find.
That's correct. So I think it was quite eye-opening at the time, just when I was very young in the investing journey. And you got to meet with some very exceptional fund managers at the time, and also some very average fund managers. You could see a manager that have maybe value stocks bias. You might have seen another manager that might only invest into larger companies versus smaller companies. You would also see another manager that might just invest into quality businesses versus not so much in lower quality businesses, etc., etc. And what you try to do is analyze what were their biases and how much value they are adding on top of the biases. And as everyone would know, every investment approach would go through a period of headwind or favorable conditions or unfavorable conditions. So hence, it's very important to understand what is driving the performance. So I think that was a time that I started to get into the different definitions.
In other words, with the headwinds and the tailwinds, when is your investment style actually delivering, or when are you simply being helped by the macro conditions that surround the companies that you're investing in?
That's right. And then the next conclusion, which is the topic that we're talking about today, is I would believe that any successful investor is a value investor. And the simply definition is achieving outperformance, and at the same time buying low and selling high.
Which sounds pretty fundamental to me. If you're investing, that's buying low and selling high. How then? Let's go through these different definitions and explain what we mean. A bit like an exam question. In order to answer this, we must first understand what is value. Before we get to your conclusion, describe what is value in terms of a value stock. What does that mean?
So value. In any stocks, I will come back to value stocks in a second, it simply means mispricing. So you're buying something cheaper than the share price imply, and then you're able to sell it at a higher price that the share price no longer imply those mispricing, which might become overvalue or maybe in line or fairly value at the same time. If you are going into the different stocks characteristics, such as value stocks, the simply definition is just about low PE ratio, price to earnings ratio, or low price to book ratio, very short term. So you're probably looking at just between the next year or the next 3 years, or maybe you look at historical.
And price earnings, just to explain, that price earnings ratio is a way of understanding whether a company is actually cheap, that you're not paying lots of multiples of how much it earns per year, which is what we were talking about before with NVIDIA, for example, that if it's a low ratio, it's only a few times the annual earnings.
That's correct. But typically, though, just because the market is very efficient, so when you think a company is trading at a very low multiple, typically it implies that the company is not doing very well. So either the company is very cyclical or maybe it's very low quality.
People tend to believe in the efficient markets hypothesis. If it's cheap for a reason.
It's cheap for a reason.
Okay, good. Can you give me an example of a company like that?
So over the last couple of years, Leonardo, Italian defense company, would be a very interesting case study here.
There's a Leonardo that used to be Finmeccanica, an Italian company that it changed its name.
That's right. So if you look at European defense companies such as Leonardo, over the last 20, 30 years or so, there's little growth in those companies just because the defense spending in Europe is very much in line with the European GDP growth, which is not a lot, as we know. At the same time, most European countries over the last many years were underspending what they require to spend. So then when you look at the valuation of Leonardo, let's say back in 2021, before the Ukraine invasion, it was very lowly rated in a way that the PE ratio would probably be in low double digit. And it's not growing very quick. It's nothing exciting about. It's a good company. And if you look at the return profile, let's say investing in Leonardo the 10 years before, you probably haven't made much money, right?
So it was a good company, but in a relatively sleepy sector because its customers, the countries within Europe, had dialed down their spending on defence. This is the peace dividend since the Cold War ended. So there wasn't much demand. But that's changed, didn't it?
That's right. So in order to make money, which means outperformance from investing into European defense, is you need to take a forward-looking view, which is buying low and selling high. So how do you do that? The starting point was on the back of the Ukraine invasion. I think suddenly European Union have woken up the fact that, okay, maybe Russia is a threat that they probably have been ignoring for the last many years. But I would say what has been quite game-changing was on the back of Trump coming to the office. And of course, if you follow the US politics in Europe, that Trump literally have said at the beginning of the year that we're not going to provide you with the backstop in Europe. Like, you need to defend yourself. Our focus is much more in Asia Pacific.
It was a jolt through European governments that it was a big shock to them. They couldn't rely on big brother's the wrong phrase to use there, but they couldn't rely on the US to come and back up Europe if there were a threat.
That's correct. So if you look at what the European Union has done this year, since the beginning of the year, is they have very much prioritized defense spending being the top of the agenda. So hence, when you look at the share price of European defense, including Leonardo, they have gone up a lot. Leonardo has gone up just over probably 70, 80% plus just this year in the last 11 months or so. And they have done very well. But that does not reflect the history. Okay, now, in today's context, Leonardo is no longer trading at a very low PE ratio just because there's a lot more of money being flooded to their revenue, so they're making more money now. At the same time, many people have woken up to the fact that the sector in itself is no longer sleepy. It's actually growing low double digit in revenue terms. That was not the case before. So it's no longer growing in line with the European GDP. It's growing multiple times faster because of the new deployment of investment.
And the fund manager's job with a value stock like that is to spot when things are changing, when its fortunes are changing, and this particular good company in a sleepy sector, as you were saying, it's suddenly going to start growing faster. That's value then. What about growth? What do we mean by growth?
So growth companies, I think people would be more familiar with over the last few years, is just simply about companies that are growing a lot faster than the world GDP.
The clue's in the name.
So you can think about the likes of Amazon, Alphabet, or even Microsoft for the 5 years or so running into the pandemic. I mean, these companies were growing very quickly. And of course, recently we have NVIDIA growing very quickly. But typically, the byproduct of this is because they're growing very fast, and people can see that. I mean, you need to remember that the market is very efficient in a way that is being priced in a manner that is the company are very fast growing in contrast to European defense. Typically, they would be trading at a much higher multiple. So it would be very unusual that you see a company growing the revenue by 30, 40, 50%, and then they are trading at a low PE ratio like European defense, for example. So typically they will be trading at probably 20, 30 times, if not a bit higher.
Okay. And you've given some examples there, but to reiterate, a growth company shows strong growth, and it makes sense to buy shares if you think they're going to continue growing. That's the point there, is it?
Yeah, so the example that I would share is probably maybe we can refer to Amazon for the last many, many years. Obviously, it was one of the dot-com darling during the tech bubble era. And later on, the share price collapsed. It came down a lot. But since then, it's recovered very strongly, and Amazon has become very entrenched to our day-to-day. I do not think Amazon is going to disappear anytime soon.
A transformational company. Okay, and finally, quality. Let's quickly cover that as well, which may be slightly harder to understand. What do we mean with quality stocks?
Typically, I would say quality companies are simply companies that have become the incumbents almost, and they are making very high margin. The example I would refer to is probably MasterCard and Visa is a duopoly, so two players market within the digital payment space in the Western world, and they're making easily over 50% margin. And at the same time, they are still growing. So it's not like they have gone X growth, but you can literally see it on a margin that if you look at even luxury brands, I mean, they're not making 50% margin, even though that we think luxury brands would have the pricing power. But for some company, they are actually making very high margin just because they have become the incumbents and there's no disruptor coming into the industry.
But the appeal, once again, for you as an investor is that you see the share price here, and whatever it is right now, whether it looks expensive or not, you expect it to go higher over a certain period.
Correct. People understand these companies are high quality, and most people are willing to pay a premium to get the exposure to these businesses. So as an investor, as a value investor, you need to be able to assess the valuation to think they are underpriced for what these companies might deliver in the near future.
Okay, and then bring it back to NVIDIA. That I guess that the surprising thing is that even when it hit $1 trillion, it is, well, it's lots of things, isn't it? It's a quality company because it's one of a very small number of companies that can deliver what it wants. It's a growth company because it had already risen from low hundred billions to $1 trillion. But the key point is that it was still a value company a couple of years ago because it went from 1 trillion to around 5 trillion today. It's extraordinary how all of these things come back together. And that's what you were saying at the beginning, that no matter what the style of company we're talking about, what you're trying to do is to spot the value in companies, regardless of the label.
That's correct. It's all about mispricing of fundamentals. And at the same time, you need to get those mispricing correct in terms of timing, right? There's no point just investing into, let's say, something that you believe is very undervalued, but no one is looking at, and then no one is going to give you that price that you expect to sell it at. And it could take a long time before everyone realizes that. What you need to do as a successful investor is not only to spot the mispricing, but you need to get the timing correct. So as far as NVIDIA is concerned, that they started to deliver those earnings very quickly, and that has been the case for the last few years, and hence, when you look at the market value of the company, it's now gone up a few times.
Is there value in those labels, though? I mean, what you're talking about there is this is all within the context of prices rising, but is there a utility in the labels of growth or quality in particular in terms of the risk of things going sour? That presumably a quality company is one where you've got more comfort that it will survive any challenges.
You need to look at fundamentals. So ultimately what it means is different companies have a different playbook. If you invest into quality businesses, you could have overpaid for the quality that is going to deliver in time. But it's more likely that the company will survive if we have another pandemic, oil price going up to $100, interest rate going up the roof, or another tariff, or maybe another budget, etc. Right? If you have invested into a low PE stock, typically it implies more cyclical businesses, lower margin, definitely lower valuation. But some of this company could disappear on the back of that. So from my personal experience, that I have a quality bias just because I don't want to wake up tomorrow to worry about whether my company would be around. But still, the ultimate question is, are you buying low and selling high? So I think every successful investor, they are value investors, embracing value investing, and different parts of the market have a slightly different playbook. If you end up investing into value stocks, which low PE, low margin, you just need to worry about more things. But you could get them right too, so then you end up delivering outperformance.
So to adapt that Oscar Wilde quote that we had at the beginning, it seems like good investors need to know not just the price of everything, but the value of everything.
The value, and then at the same time, I would probably just add, is about the permanent loss of capital. So it's not about share price volatility, whether there's a wobble in the market, people want to take profits, correlation. It's about permanent loss of capital. So you have to think about any factors, whether it's internal, from competitors, external, which is the macro world out there, is going to impair the earnings profile of your company, which then relate to the fact that you are actually buying high and selling low because the company is not worth the price that you pay for.
Okay, Stephen, it's time for the Outperformance Matters Mythbusting Toolkit. What, Stephen, is your investment myth, the one that you want to bust this time?
The myth I would pick is the cheapest fund wins.
That's wrong.
That's wrong.
Why is that?
Okay, there's three scenarios here. The first one is if you assume every fund is going to give you the same return, just like you put your money into a saving account, then of course the cheapest fund wins, right? Just because you're getting exactly the same return is commoditized. The second scenario is if you have just delivered the same return before fees with another fund, then if you lower your fees, you would deliver better return. So this is a very marginal
improvement,
but the fees would matter. The third scenario, which is what we're about in terms of Outperformance Matters, is if you're aiming to deliver material returns, then the fee element is a very small part of the performance because ultimately performance is net of all fees.
So look at the outcome that a fund manager manages to deliver rather than focusing too much on the fees alone. They are an important part of it because they do get taken out of the returns that any investor sees, but they can be dwarfed if the outcome is much larger.
Correct. If you're not delivering, then you need to look at fees. If you are, then people should focus on the outcome.
That's clear. Thank you very much, Stephen. Another myth busted. Okay, well, finally, we're delighted to receive listeners' letters and emails, and often they come in with questions. We've got one this time from Johnny, and in fact, we can hear him ask his question.
In a recent episode, you described being forced to sell off stock that were performing well, but exceeding the limit you're allowed to hold. It sounds like this happens pretty frequently with stocks such as Nvidia. What impact do the associated trading fees have on the fund's returns? Is there a plan to make this efficient?
Thanks, Johnny, for the question. So I would have to say that the trading costs typically are very small parts of the return, just because it's a very competitive world out there. Of course, if you do not need to sell, you do not need to trade, I think it helps too. But ultimately, it's about the outcome that you deliver. For example, in our case, selling Nvidia at a profit continuously over the last few years, the trading cost is almost immaterial to think about. But if you're selling a company that continue to not make you money, then of course, it's not going to be a helpful contributor.
So a little bit like the fees, you're saying that the trading costs in the context of the outcome are very small if you're a successful fund manager delivering outperformance.
Correct.
Right, well, that's it for this episode. Thank you, Stephen Yu of Blue Whale Capital. As you've heard, we love getting listener questions, and Stephen will try to answer your questions about Outperformance Matters and other things. Write to producer@bluewhale.co.uk. In fact, the next episode in early December will have a special around listener questions, so do send them in there. Thanks for listening. If you've enjoyed this, do tune in again and leave us a review on your favorite podcast platform. Remember, Outperformance Matters. Goodbye.
Please note that this podcast is issued for educational purposes only by Blue Whale Capital LLP, which is authorised and regulated by the Financial Conduct Authority. Views expressed on companies, markets, asset classes, and investment strategies do not constitute investment recommendations and must not be viewed as such. Listeners should note that no longer be current and may not be revised or updated. Nothing in the podcast should be viewed as comment on the suitability of any investment. If you are unsure of the suitability of any investment for your needs, or if you feel that you do not fully understand the risks of investing, you should obtain financial advice from a reputable professional financial advisor before proceeding. You are reminded that your capital is at risk. The value of investments could go down as well as up, so you may get back less than you invest. Tax treatment depends on personal circumstances and may change. This podcast is directed only at UK residents and does not constitute an offer or a solicitation in any jurisdiction.